Hello students, this is the recording for your final exam review. I hope you enjoy it. It's kind of pure improvisation from my side, but let's see how it goes. First, I want to show you where the final exam questions are located. You can find them on Blackboard. Once you click on in your course, on the left side, you're going to see final exam preparation questions. Once you click on that one, there'll be a final exam preparation question in red, just to drag your attention, and then the question is going to pop up. It's 39 pages, but it's going to include not only the questions, but some additional questions for you to practice as well. Now I'm going to go over the questions, try to go over every single each of the questions. Some of the questions are repeating, so I'm going to leave it for you to practice as well. I hope that's going to help you to have better success on your final exam. So I'm going to start with sharing again the screen, and I'm going to show you the questions, and we're going to go over every single of those questions. Let's start with question one. Question one is about bank reconciliation. As you can see, the bank reconciliation format is a little bit changed from the one that we did in the class and the one that you did in the final test. However, try to make it as close as possible to the environment that you're going to take the final exam, which is Pearson. So let's try and see how this is going to work. First question, it's about this company, Davidson Insurance Company. What they have, what they give you is the cash receipt journal and cash payment journal. Cash receipt journal is the cash that's coming in. Cash payment journal is the cash that's going out for the company. Also, they clearly give you the cash account balance at the end of the year, which is $17,450. This is your starting point when you start the bank reconciliation for the books. Next thing that you're going to see is the bank statement for December 31st. And as you can see in the bank statement, you can see there's a beginning balance, there's a total deposits that going in the bank account, total withdrawals, charges, $10 service charges, and ending balance. So technically how this works, beginning balance plus the total deposits minus the total withdrawals minus the $10 gonna give you $18,955. So $18,955 is your starting point for the bank reconciliation. So what I'm gonna do is I'm gonna grab this, I'm gonna copy it, and I'm gonna move to Excel spreadsheet, and I'm gonna show you on the Excel spreadsheet how you're supposed to do the bank reconciliation. Now I'm gonna share my screen, and I'm gonna explain there. Okay, now let's move to the Excel spreadsheet. So we have two sets that we have to do. We have clearly the books, and we clearly have the bank. So on one side, we're going to have the bank, and on the other side, we're going to have the books. Bank, we're going to start, beginning balance will be December 31st. And as we can see, if in the bank, the beginning balance for the bank is $18,955. We make some adjustments here to the numbers so you can see it clearly and the format that's supposed to be more useful for you. There's no pennies, so we're going to eliminate the pennies. There'll be no decimals, and that's how the number is going to be shown here. And we can do the same formatting for the rest of the columns. So we're going to have the same formatting. We don't have to do any formatting anymore. So the bank, this is your bank starting point with the bank. And we're going to start with the beginning balance at December 31st, which is 18,955. Now to the bank, what we have to do, we have to add any deposits in transit that we may have, which are recorded in our cash journal, but not yet deposited in the bank. That's the first thing that we have to do. And the second thing that we have to do, we have to deduct any outstanding checks, which outstanding checks are means that they're already in our cash journal, they're already deducted from our cash, but they haven't been cleared from the bank. So basically, they're not yet deducted from our bank balance. For many reasons, the customer doesn't want to, that will be the vendor in this case, the vendor doesn't want to cash the check or holding for something else. There are so many reasons why somebody doesn't want to cash his check. But let's leave that for the person who cashing the check. Now, the next thing that I want you to observe is there any other information in the question that we need to be aware of? Once we have those two, we can see that there's some additional information, which additional information gives you idea about some events that that happen in this particular case. The requirements are prepare the bank reconciliation, journalize any required entry from the bank reconciliations. Those are our requirements. So what we have to do, go back to the Excel spreadsheet and start working. So we're starting first with our deposits or the cash that we recorded in our books, and we're gonna chase, is this cash actually being deposited in our bank account? So the first cash deposit that we make in our general ledger in our cash was for $2,240. $4,240. Do we have that kind of deposit in our bank? Yes, we do. First deposit is for $4,240. So this deposit from our books was deposited in the bank. So we don't have to do it. That's not in the transit. It's already been deposited. Second one, on December 9, we have deposited in our books $550, which were deposited in our bank account. So that deposit is not in transit, it's already been deposited in the bank. Next deposit in our books is for $600. And if you check the bank, we have the same amount deposited in our bank account. So that deposit is also not in transit, also already been deposited. The next deposit is $1,900 on December 17, which $1,900 has been deposited in our bank account. So this deposit is also not in transit, has been deposited in the bank. The last deposit on December 31st for $1,860. This is the one that it might not be deposited, and once we check the bank, we see that on December 31st there is no deposits there for 1,860. What that means is the cash has been shown as a receipt in our books, but is not deposit yet in the bank. So where is the cash? The cash is in transit. So that's what we're going to do here. We're going to add it to our bank balance, available bank balance. Why? Because we expect that cash to come to our bank account. So that will be deposited on December 31st. And we're going to add in our bank account amount of $1,860. Once we add this amount, our bank balance would be $20,000 $850 available cash that we can work with. Now we have to see, is there any checks that we issue and send to the vendor that hasn't been cleared yet from the bank. Now on deposit sides, what's left? We have here EFT for $350 left. And also we have the last deposit, which is BC, says $1,400. So those two, I'm gonna leave it like this, and we have to chase them later. Now let's see the checks. For the checks, we're not gonna go the same day, the way we did with the deposits, first to see if the deposit was deposited in our books and then chase it in the bank. We're gonna go the opposite way. First, we're gonna check the bank, and then we see is this check was in our books, and is it for the same amount. First check that has been cleared in our bank was check 1416 for $810, which was issued. It's already recorded in our books, so everything is good. So the check from the books has been cashed, so that's not outstanding check. Next check is 1417 for $180, which we have it in our books. This check is also clear from our bank account. The money are deducted from our bank account. Everything is the way it should be. Next check is 1418 for $630. That check was issued and recorded in our books, also cleared in our bank account. There's no problem with that check. Same number of the check, same amount, everything looks in order. The last check that was cleared in our bank account is 1419, and that amount in the bank is 1,000. That's for check number 1418. That's what $1,930 was taken out from our bank account. In our books, however, that's for the bank. In our books, however, showing different amount. In our books, that's the same check, 1419, is sitting for the amount $1,390. That's in our books. So what that means, the bank took more money from our bank account than we deducted from our cash in our books. So what we have to do now, we have to find out who made a mistake. So if the bank made a mistake, we have to add whatever the mistake is, or deduct it. We have to add, if the bank took more money, we have to add those money to our cash. If we made a mistake, then we have to deduct more money from our cash. So let's take a look at the additional information that we have available and figure out from there who made a mistake. As we can see here, there's information. The correct amount of the check for rent expense is $1,930. The controller mistakenly recorded the check as $1,390. So what's happened is our controller, the person who's doing the signing the check or issuing the check, he recorded, actually the check was recorded, issued for the right amount, but the journal entry was wrong. Our cash was deducted only with $1,390 in our books, from our books. The actual amount that has to be deducted from our cash in the journal ledger from the cash is $1,930. So bank is right. Let's go back and figure out how to deal with this situation. First, we have to find out what the mistake is. So the mistake in this case is 1,930 minus 1,390, that's $540. $440. That means we have to deduct cash from our general ledger. Since we are the one who made the mistake. And we took less cash, we deducted less cash, we recorded less cash than the actual cash taken from our bank account. That mistake doesn't require any adjustment in the bank. We have to do the adjustment in the books, but let's leave it on the time when we're doing the books. Just we're gonna mark, we have to deal with this check later on. So at this point, we have to see how many checks left in our books which hasn't been cleared in bank account. First check is check number 1420. Second check is check number 1421, and the last check is check number 1422. Luckily, they're by numbers, one after another, so there's nothing scary here. 1,490 is the first one, 700 is the second one, and the 610 is the third one, which give us the total of $2,790, which we have to deduct from our cash. So once we deduct that cash, we're gonna get the adjusted bank balance at December 31st. And that will be, again, this amount minus that amount. And that's going to be $18,025 should be our ending balance in our bank account. So what we have to do, somehow magically we have to have that number once we finish our exercise with the books. Now the books, what we have to do with the books? The same, exactly the same. We're going to start with the ending balance for the month, and then we have to add something and deduct something from the book. Let's do some adjustments here to make it nicer. So that's our book, and the beginning balance for the starting point for our books will be December 31st again. And we're going to check our question, and we're going to see where is the balance for the books at December 31st. And as we already said, our balance is $17,450. I'm going to copy this amount, and with that amount, I'm going to go directly to my Excel spreadsheet, and I'm going to paste that amount into the Excel spreadsheet so there will be no mistakes on my end by transponding that number. $17,450. I have at my starting point. Now I have to add something, and then probably have to deduct something. Let's figure out what first we have to add. So what we're doing here, the idea is there anything that's coming in our bank account which hasn't been recorded in our books? First, we're going to check the deposits, since the deposits are the money coming in our bank account. First thing that we can see on this December 1st, there's a EFT deposit of $350, which I don't see as a deposit in my cash receipts journal. Second thing that I can see was on December 22nd, there's something called BC. We're going to find out what is that. That's for $1,400. Those two amounts are not in my cash receipts. So what I have to do, I have to add it to my cash. Once I'm done with the deposits, then I'm going to look for is there anything that going out of my bank account which is not reflected in the cash payments journal? And we can see there's things that going out of our bank account. First one was service charges. And that service charges are for $10. Now I'm going to make it a little bit bigger, and then that will be $10 here. Second thing that you can see is NSF. I have other deductions. Those are deductions. That means money going out from our bank account. On December 8th, I have deduction of NSF for $400. Money are taken out from our bank account. And the last thing that I can see is EFT for $225 taken out of my bank account. The last thing that we have to deal with was the check and the mistake with the check. And what we said that we have to, since we are the one who made the mistake and we're the one who deduct less money than we're supposed to deduct, we deduct for $540 less from our cash on the cash payments. So we have to deduct more cash. So we have to less the cash. So that will be that's for the check, 1419. And we have to add another $450 deductions to our cash. So the total cash that we're going to deduct would be for the amount of $1,175. And the total cash that we have to add on our cash in our journal would be for $1,750. Once we do those two things, we have to see what will be our adjusted book balance at December 31st. If we do those two, when we're starting with the beginning balance plus money coming in our bank account as a EFT and BC, whatever that is at this point, we're going to chase a little bit later what exactly is the nature of those two deposits. And once we deduct the service charges, NSF that's going out of our bank account, we're going to see later what is that. EFT, we're going to see about the EFT later because that's deduction from our cash, and the mistaken amount of the mistake that we made, we should naturally get balance of $18,025. Once we get that balance, we automatically can see that at this point our book and our bank are at the same point of $18,025. Once we do that, we can say that our bank reconciliation is in order. At this point, we can ask, what's the amount of the cash that I have available at this point? And you can clearly see that the amount of cash that you have available at this point is $18,025. Why is that? Even though the bank shows that you have $18,955, after you deposit the last deposit that you made in your books for $1,860, and vendors clear their checks for $2,790, your balance in the bank should naturally come to $18,025. So the $18,025 is the amount that you have available as a cash at this very moment. Now let's take a look what was that EFT deposit coming out in our bank account. Then we're going to check here the additional information that we have available in the question. As you can see, there's additional information. I can clearly copy this information and move it to the Excel spreadsheet and working on the Excel spreadsheet. Here we go. And I'm going to post it like this. So we have all the information on one place. First thing first, EFT credit was received on rent. Credit means deposit for us. So EFT.EFT we can add rent revenue. Why is revenue? Because the money coming in our bank account. The next thing that coming is BC, and we can see here the BC is the bank collection was on the note receivable. So we collected money on the notes receivable. And that's the second one. Mystery is also solved. We know now why we receive $1,400. The service charges, those are related to the bank expenses. Those will be service charge expense. $10. NSF was received from a customer. So our customer paid us. The bank tried to clear the check from his bank account. The bank found out there's no money in our customer bank account, and they took the money back from our bank account. So that is clearly related to accounts receivables. NSF, remember, NSF is related only and only to accounts receivables, only and only for customers, which we made the sales on credit. Next thing is electronic fund transfer, and that was related to the insurance payment. So our account was debited. That means the money are deducted from our bank account for $225. That is related to insurance expense. And the last one was for the check, which is for the rent expense. So what that means to us, we have to add more to the rent expense. The amount mistakenly was recorded for $1,390, which is $540 less. So what we have to do? We have to do, in order to adjust our books, because at this point our books are sitting at $70,450, we have to add to our cash those two items, and we have to deduct from our cash those items. Once we do that, our cash balance from 17,450 is going to become 18,025, which is our objective. So how can we do that? We have a special tool which is called journal entry, and with the journal entry we can add cash. Means that once we add cash, that means we have to debit our cash account, and if we have to deduct or less cash, that means credit to our cash account. So our journal entry will be debit plus cash for the amount of $1,750, and we're gonna credit first our rent revenue for the amount of $350, and then we're gonna credit note receivable for the amount of $1,450 or $400. First entry is done. Second entry. The second entry, we have to deduct the cash. Deduct the cash again means credit cash. So we can first start, if you want, start first with the credit, since you know the credit is cash. Credit is cash. Start with what you know clearly, and the total cash that we have to deduct is $1,750. Then start with the debits. First debit will be related to the bank service fee expense, and that's for $10. Then we have the next amount, which is $425 and $540. Second debit is for the accounts receivables. The third credit is for insurance expense. And the last credit and debit, sorry, is for the rent expense. And once we do those two journal entries, our cash naturally is going to come to 18,025. Why? Because we started with $17,450. Once we had 1,750 and deduct 1,175, our balance in our cash books will be $18,025. And that's your first question here. That will be question 1. Now let's start and look for the second question. Let's see what the second question asks and what we have to do with the second question. Second question, this is the solution that we have already posted. As you can see, all the things that we talk about are already shown here and the journal entries are shown. The only thing that I did different from the question is that the journal entry for every single event, you have to do the separate journal entry. So one entry for the rent revenue, one entry for the note receivable, one entry for the rent expense, one entry for the accounts receivables, one entry for the insurance expense, one entry for the bank service expense. All one entries. So once you do that, we're moving to this question 2. Question 2 looks very much like the question that we did in the class before the start of your test. So I'm going to leave question 2 for you for practice. And I'm going to move to question 3, which question 3 again is the very similar format to the question that you're going to see in Pearson. It's very similar to what we just did. So what I'm going to do, the same thing, I'm going to copy this and I'm going to move all those information from our general ledger and information from the bank into the Excel spreadsheet. Just give me just a few seconds to flip that information. And I'm going to get the information from the bank and we're going to start working on the question to see what we know, what we don't know, what the problem is, and how can we solve it. First thing first, let's observe the information very quickly. We have to do the bank reconciliation for the month of May. We have the cash records, which is the cash coming in, cash going out. Our cash account shows balance of 17,750 at May 31st. This company, its insurance received the following bank statement. Beginning balance for the bank for May, deposits, withdrawals, money taken out from our bank account, service charges, and the balance. Additional information is one of the electronic fund transfer credits. The first one is related to rent. The debit, electronic fund transfer debit on May 19 is the insurance payment. Non-sufficient fund check is received from the customer, so that means accounts receivables. The collection BC, bank collection, is related to the note receivable. And now the correct amount of, there will be problem with check 1419. So 1419, as you can see, the bank recorded 1,900. We recorded in our books, we flipped the 9 with a 0, $1,090. Bank is correct and controller made a mistake. Short with $810. That should be $810. What we have to do, bank reconciliation for the month of May and journalize the entries from the bank reconciliation. So what I'm going to do, I'm gonna flip back to the Excel spreadsheet. Now, since I already have one Excel, I don't have to do it again. I'm just gonna erase the information that I already have available and gonna work with the same template that we already work with. So what I'm gonna do, I'm gonna erase this information completely. I'm gonna start, yes, I can easily start again. And that additional information for our work, that's different. We're gonna see which account are debit and credit and so forth and so forth. So first, we're gonna start with the bank with the beginning balance, which is at May 31st in this case. And our balance here is for the amount of $18,730. That's our starting point. Then, as we said, we're gonna start chasing money coming in our bank account and money coming in our cash account. Are those the same amounts? And is there anything in our cash account that hasn't been deposited in the bank? So the first money that's coming in our account is on May 4, 4,230. Was that deposited in the bank? Yes, it was. Second deposit for $520. Was that deposit in the bank? Yes, it was. $420. Next deposit of $530. Was it deposit in the bank? Yes, it was. Next deposit on May 17 is for $1,950. Was the deposit in the bank? Yes, it was. And the last deposit on May 31st, $1,940. As you can guess, since it's May 31st in this case, most likely won't be deposited in the bank in order to have a case. So in fact, it wasn't deposited. So what we have to do, we have to add it. And we have that added that deposit in transit. And that's deposit at May 31st for the amount of 1,940. And at this point, we check all the deposits which are made in our books, and those now are reflected either as a money deposit in the bank, either as a deposit added to our bank balance. Next thing that we have to do is to check, is there any outstanding checks that we have to deal with? So less will be outstanding checks. Same idea like before. Now we're checking the checks which are clear in the bank and try to match them with our books. First check which was clear in our bank was check 1416 for $890, which we have it in our books with the same amount, so everything looks okay. Next check is check 1417 for $120, which we have it in our books, so everything looks okay. Next check is 1418 for $630, same check appears in our books, everything is okay. The next check is a check 1419 for $1,900, which is different in our books. Again, we're going to put a note here, and we're going to see that check for number 1419 for $1,900. There's a problem with that check. That's sitting in the bank. In our books, we have a different amount, which amount is 1418. $1090. That's in our books. Books should look like this. So our difference here, we have a difference of exactly $810 difference. What we have to see who made a mistake. The bank made a mistake or we made a mistake. If the bank made a mistake, we have to adjust our bank balance. If we made a mistake, we have to adjust our books. For that reason, we're going to go back to the question and see what's happening in our question. In our question, we can see that we have the following information, which is the additional information. I'm going to copy this one so I don't have to come back and forth. So I'm just going to copy this. This time I'm on the wrong spot, but you still can see it. Let's go back to the right spot. Which was our Word document. And from the Word document, I can scroll down and grab this information and copy it and move it into the Excel spreadsheet. Once I go to the Excel spreadsheet, obviously I'm going to post this information here. And now I have that information. I don't have to worry too much with that information. So what that information says, let's move this line here. That information says that the correct amount of the check 1419 for the rent expense, or still the rent expense, is $1,900. So the bank is correct. We made a mistake for $1,080, so we made the mistake for $810, which means that we deducted less cash from our books. Bank deducted from our cash balance, from the bank the correct amount. So what we have to do, we have to add additional cash deduction to our cash. So that means we're going to deal with that when we comes to the book. We're going to make a note here, check 199. We have to 1419. We have to deal with this later. So which checks left? We have 3 checks that left: 1420, 1421, and 1422. And once we add those questions, 1420, 1421, and check 1422, all those are for, first check is for the amount of 1420, $900 and $670. That's going to give us total of $2,990, which I'm going to flip right here. And that's the amount that I have to deduct in order to get our book balance. And the book balance in this case will be this amount minus the outstanding checks. It should be $70,580. Now we have to get the same amount sitting here. That will be our adjusted bank balance at May 31st. Now we have to do the same thing with our books. Again, the books, we're going to start with the beginning balance, which is the ending balance of May 31st. And that balance, we can find it in our question. Once I move to the question, we're going to see that here we have, in the question, we have the amount of 17,750 is our account balance at May 31st. I'm going to copy this number so I don't make any mistake with the transponding the numbers. And that will be my starting point here for the books, 17,750. Then I have to add something and I have to deduct. What I'm going to add? First, we're going to chase, is there anything coming in our bank account as a deposits, which hasn't been recorded yet in our books? And yes, we can see on May 1st, we have electronic fund transfer, which electronic fund transfer credit was the rent again. So we can add EFT, that's for the rent revenue of $450. Next thing that we're going to see, which wasn't in our books, was that BC. And the BC here says that's a bank collection for the note receivable. So we're going to see BC, that's a note receivable. The bank collected the money for us, and that money is $1,700. So the total of those two amounts is equal to, get it here, this amount plus that amount. The total is $2,150. Now we have to see, is there anything that is deduction from our bank account, but we don't have it in our cash journal as a payment, cash payment. So first thing first, charges. We don't have the service charges. So let's go deduct those service. Try to deduct first the easy one and then leave the next one. And the service charges are for the amount of $35. Next, we're going to have other deductions. As you can see, the first deduction is NSF for $1,100. And NSF here, we're going to see that that's related to the customer. That means accounts receivable. Customer paid us. Bank gave us the money in the beginning. They tried to get the money back from his bank account. There was no money in his bank account, and bank get the money back from our bank account, $1,100. The last thing that left here as other deductions, non-sufficient fund electronic fund transfer on May 19 for $375. And as we can see here, that is related to insurance payment. So that electronic fund transfer is related to insurance expense. And that's for the amount $375. The last thing that left is we to deduct from our books $810, which are related to check 1419, which check was originally for rent expense, with $810. Once we do that, the total amount that we have to deduct will be equal to all those four amounts. Once we get it total, we can check, is that going to be, is the adjusted book balance at May 31st will be exactly the same as the adjusted bank balance. So let's see how this is going to work. This amount plus this amount minus this amount should give us $17,580, which is exactly the same as our book balance. Since I haven't erased the links between the first template that we made and this one, I already have the amounts of my journal entry. What I have to do, I have to add the cash. Adding the cash to make the journal entry to adjust the cash. Cash, adding cash, that means debit cash, and less means I have to deduct the cash, which will be on the credit side. So first will be debit cash, and then I'm gonna with the total amount, and then I'm gonna credit first rent revenue. Then I'm gonna credit note receivable for the money that the bank collects for me. Then I'm gonna debit service. Bank service expenses or service bank expenses. Then I'm gonna debit accounts receivables. Then I'm gonna debit insurance expenses. And the last thing that I'm gonna debit is rent expense. Now what you have to do in Pearson, you have to do it as a separate entry for every single one. So debit cash, credit rent revenue, debit cash, not receivable, debits bank service expenses, credit cash, debit accounts receivables, credit cash, debit insurance expense, credit cash, debit rent expense, credit cash. And once you do that, your cash naturally is going to be equal to the adjusted bank balance. We're gonna just adjust our cash. The cash, our books and our books gonna show the correct amount of money that we currently have access to, and that is not the balance that bank show us at this moment, because that bank doesn't account for the deposit in transit that will come to our bank account and the outstanding checks which are not clear yet by the vendor. That's your second question about the bank reconciliation. So I believe at this point we spent more than enough time on the bank reconciliation plus the test that you did in the class. That should give you a good confidence for the final exam. Next thing that I want to, again, here you can see on the solution and the journal entry following one after another, one after another. Again, it's not combined entry, it's a simple entry, one after another. Next thing that I want you to pay attention is there'll be a question that's going to ask you specific events, and you have to answer: is this related to the bank? Is it related to the book? Does it have to be added to the bank, or it has to be deducted from the books? What exactly is? And this chart's going to give you the perfect template, if you can say, with the general rules for the bank reconciliation. What you have to add, what you have to deduct, why you have to add it, why you have to deduct it. Remember, in the bank, you're adding all the deposits which are in transit, means deposit was made in the book, not deposit in the bank, and all the outstanding checks means those checks are already recorded in the books but not clear yet in the bank. The other thing that you either you have to add or deduct is any mistakes that bank made. General rule, bank never made the mistakes, but you never know, sometimes they do. Once they do make mistakes, they're gonna give you money back if they deduct more money for you, or they're gonna take the money back immediately when they they made a mistake and they deduct less. So for the books, that's a different story. For the books, you have to add any money that's coming into the bank account in forms of electronic fund transfers, bank collections, interest revenue, and you have to deduct non-sufficient fund checks, any printing costs that you may have, bank service charges, and plus and minus any book errors. And don't forget, even when you have the electronic fund transfer, those can be electronic fund transfer related to the deposits in the bank account or deductions from the bank account directly. Everything which is in the bank but not in the book, you have to reflect it in the book. And the opposite, everything which is in the book but not in the bank, you have to adjust the bank balance. We're not correcting the books for the events that are related to the bank. We're not adding it because we already have those one in our books. That's with the bank reconciliation. That's for question that's gonna come from chapter 7. There will be one more question from chapter 7. We're gonna see it at the very end. That's related to the PT cash. Next question that's gonna come on the final exam will be from chapter 7. Chapter 6. Was it 6? No, chapter bank reconciliation, chapter 8. I'm sorry. Chapter 7 is the accounting system. For the accounting system, there will be special events the same way that they were in the test. So what you have to do is you have to decide to which journal those events belong to. And this chart is the perfect chart that's going to show you how to deal with every single event. So what's the question that you ask? First question. Let's say first we receive cash from customer. We're receiving cash from customer. What do we have to do with this? Which journal shall we use? First, does this transaction involve cash? Yes, it does. Did the company receive cash? Yes, it did. So we have to record it in the cash receipt journal. Let's pretend that we provide service to the customer on account. Does the transaction involve cash? No, it doesn't. Does the transaction sells on account? Yes, it is. Which one? Record as a sales journal. Next one. Let's see something interesting. We receive the inventory, we purchase inventory on account, we don't like few items, and we decide to return those items, return the items to the vendor for which we purchased that. Now let's see. Return. Is this transaction involve cash? No, it doesn't. Why? Because I haven't paid for it, it's on account. Is the transaction sales on account? No, it's not. Is this transaction purchase on account? No, it's not. It's return. So where I have to go? On the general journal. And from the general journal, I have to make the correction entry. That's how you should read this information. That's how you should apply it to every event that you see on your question from chapter 7, which is going to come on the final exam. That's from chapter 7. Chapter 6, 5 and 6. Let's see first chapter 6, and then we're going to go to chapter 5. This question is the one that gives you the most problem and the most trouble during the course. So let's copy this question. We're going to flip on the Excel spreadsheet. But before we do that, let's think about it and this question. First thing first. From the chapter 6, I'm going to give you only and only periodic inventory to calculate periodic inventory. Perpetual, we're not going to be tested in the forms of a question. It might be some questions with the from the multiple choice questions that I might say perpetual. I'm not 100% sure, but even if that's the case, the only thing that's going to ask you to calculate will be the first in, first out inventory, nothing else. Moving weighted average is not going to be tested. So, on the periodic inventory system, why we have periodic? Because on the periodic system, we counting at the end of the period how many items we have. Then we chasing the purchases. At the end of the period, we calculating the ending balance. And once we calculating the ending balance, we can calculate cost of goods sold. What that means? That means we're not recording cost of goods sold at the time that we're doing sales. We're recording cost of goods sold at the end of the period when we calculating the cost of goods sold by using the logic that beginning balance plus the purchase is going to give us available. Here is the formula. Where is the formula? Let me find it for you. I know it's somewhere here. Beginning inventory plus the net purchase is going to give you cost of goods available for sale. Once we count the ending inventory and we find out how much is the ending inventory, we're going to deduct it from the available and we're going to get cost of goods sold. If we know cost of goods sold, then we can find the ending inventory. So let's go back to our question here and let's start calculating. So we can see our beginning inventory. We have the purchases. What do we have to do? We have the ending balance. 4 units are counted. at the end of the period. What we have to do, we have to compute the ending inventory and cost of goods sold using first in, first out, and the same thing using the weighted average cost method. So again, I'm going to copy this table, and since it looks like Excel spreadsheet, there should be no problem that table to flow on the Excel spreadsheet which we're using. So let's see if that's the case. I'm going to share my screen with the Excel spreadsheet. Now I'm moving to question 3, and I'm going to post it, let's say right here. Yes, exactly what I expected. No problem with transponding the numbers. So we have all the numbers that we needed for the month of July. So since those numbers are a little bit different, let's do some adjustments here. First, in order to get the beginning balance, what do I need? I need the number of units. And the next thing that I need is the cost per unit. Once I have those two, I can get the total cost. So my beginning balance on July 1st, I have 6 units at the cost of $60, and that's going to give me the total cost of this one time that one, $360. That's my total cost for my beginning balance. Let's make it nice and easy for you to follow it. Next thing that since I have my beginning balance, next thing that I have to do is to find out my purchases. I have on July 8th, I have purchase number 1, and with the purchase number 1, I purchased exactly 5 units at cost of $67 per unit, and that gave me total of, that's going to give me total of like 335 units, $335, sorry. So my purchase cost me $335. Why? Because I purchased 5 units and the cost per unit was $5. Sorry, $67 per unit. Then we're gonna go to the purchase number 2, and the purchase number 2 will be for 10 units, and the cost per unit is $17. So we paid, it cost us $700. The last purchase that we made was purchase number 3 of 5 units of $85 per unit, and that's going to cost us $425. The question now is, how many units we have available? At this point, we have available exactly 26 units. What's the total cost for those 26 units? How much we paid in total? In total, we paid $1,820. We have our available. Now, if we want to find the cost of goods sold, what do we need? We need the ending balance. How many units we have at the end? Once we deduct the ending balance, we're going to find our cost of goods sold. If you look at the question, let's go and check the question. And the question is going to tell us that at the end of the period, at the end of the month, we have exactly 4 units of merchandise inventory on hand. Only 4 units. So let's go back to our Excel spreadsheet and imply those 4 units as our ending balance. Sorry, not this one, wrong sharing. our ending inventory as a number of units is 4 units. Now we know how many units we sold. That will be available minus the ending balance as a number of units. So we sell 22 units. The question is, what's the cost of our 4 units and what's the cost of our cost of the units that we sold out of 1,820? This is the total cost that we have available. So now we have to split this cost between the ending balance and the cost of goods sold. And for that, we have two methods. First method is first in, first out. Second method is the weighted average. So since I have this, I can flip it here, exactly the same thing, and work on this. How I can work? First, I'm going to extend those cells a little bit so we can see the numbers. And then I'm going to label this one, cost per unit, like this. And then can even make it more fancy here just to be nice and neat. And now I'm going to start thinking. If I'm using first in, first out, what will be the cost of my ending inventory? Obviously, the cost of my ending inventory will be the cost of my last item that I purchased. What was the cost of my last item that I purchased? $85. How many items I purchased? 5. So from where those 4 units that I have available at the end as ending balance, from where they came from? They came from the last purchase number 3. What was the cost per item on that particular purchase? $85. Not 850, only $85. So what's the cost of my ending balance at this point? That will be equal to 4 units times $85 per unit. My ending balance 340. Since 340 I have as an ending balance out of 820 available, the rest is my cost of goods sold. So my available minus 340 is going to give me the cost of goods sold, which is $1,480. And my problem here is solved. I get my cost of goods sold and I get my ending balance. Both of those available for me under first in, first out. Why? Because those two together is going to give me the what I have available, $1,820. That's if I use first in, first out. Let's see what's going to happen if we're using the weighted average. Copy and paste here, and now I'm using weighted average method. For the weighted average method, I'm going to ask myself this question. I have 4 units available at the end, which are on hand. Now the question is, during the period I had the beginning balance, which is 360, plus I made purchases. I know I have 26 units. I know it cost me $1,820 to get those 26 units. What's the average price per unit? Well, in that case, obviously the average price per unit will be the total cost divided by the total units. And my average price is exactly $70 without anything behind. Exactly $70. So If I'm using that weighted average, what will be the cost per unit of my ending inventory? Exactly the same, $70. So what's the cost of my ending inventory? Since I have 4 units and my average cost per unit is $70, my ending balance 280 out of 1,820. The rest is my cost of goods sold. And that's how you get the cost of goods sold using weighted average. So what do you need? You need your available. That's your key point here to get the available. Once you get the available, then everything is easy. You can easily get the ending balance depending on which method using, first in, first out, or weighted average. Just figure out what the ending inventory is. Once you clear the ending inventory, next one is the cost of goods sold. That's will be question 4. Let's move to the next question. The next question, first the solution, which is going over the same idea. You're getting the how you're gonna get cost of goods sold, you get the ending inventory, get the purchases, get the cost of goods available for sale, and come up with the cost of goods sold. Weighted average, come up with the total cost that cost you for those 26 units, come up with the average cost per unit, get the ending inventory, calculate the cost of goods sold. Now the next question, question 5. Let's get this information. Quickly observation of the question. We have this inventory records for this company on November 30th. Physical count of the inventory indicates that we have 6 units remaining on the ending inventory. Compute the ending inventory cost of goods sold. Each of the following methods, assuming that periodic inventory system is used. We're not going to do the specific units. I'm going to leave it for you if you want the specific units. Weighted average and first in, first out method is more important for me. Those will be tested. So I'm going to focus on those ones here only. So I'm going to again copy this information. I'm going to flip it on the Excel spreadsheet and we're going to work there. Now, just to make it easy, since I have already template for this question, what I'm going to do, I'm going to grab this question, I'm going to drag it, I'm going to label it question 5, and I'm going to start working with the new information that I have. So this information is irrelevant for me. I'm going to get my new information, which is for November. Now what I have to do is change the information. Once I change the information, everything's going to come to me eventually, I'm hoping. So beginning balance. So I'm going to erase those one so we don't have to worry about those. One is gone and this one is also gone. Let's start fresh. So beginning balance. On November 1st, I have 14 units and the average cost per unit $160. That's going to give me total of $2,240. Then I'm going to have purchase of 4 units at $170. And I'm going to have $680 total cost. Then I'm going to purchase 11 units at cost 180, and that's going to cost me $1,980. The last purchase is of 5 units, and the cost for those 5 units is $200 per unit, and I have to pay $1,000. So in total, I have 34 units, and those 34 units cost me $5,900. Right at this point, can you tell me what's the average cost per unit if we have to use the average? Absolutely. You can just copy this and flip it here, and you can easily calculate that the average price per unit at this point is equal to 173 and 53, and probably some numbers after the decimal. Pearson's going to ask you to round the number, so round the number and work with the round numbers. But once you have the number of units and once you have the total cost for all the units, you can easily come up with the average cost per unit. The last thing that left for you is to figure out where is the ending balance, so it can give you the cost of goods sold as a number of units, how many units you sold. Let's go back to the question and figure out what is the ending balance at this point. As you can see, indicates that we have 6 units remaining of the ending inventory. So let's go back and add those 6 units in our calculation. So our ending balance is 6 units. So that means we sold 28 units. The question is, what's the cost of the total cost of those 6 units? What's the total cost of the cost of goods sold? Let's pretend the first we're using first in, first out. I'm gonna copy this, flip it here, and I have it available now. Now the questions that I'm gonna ask myself is, obviously I need here one more line. I'm gonna insert one more line here. I'm gonna push everything down. I'm gonna ask myself, okay, my ending balance is 6 units in total. That's what they have, 6 units in total. From where those 6 units came from? Obviously from the last purchases. But I have a problem now. In my last purchase, I don't have 6 units. Well, you purchased before. So the first unit that you have it's left over from the purchase number 2. From purchase number 2, you have left 1 unit at $180, and the remaining 5 units to 6 are at $200. That's how your ending balance now is exactly 6 units. How many units you sold? 34 minus 1 unit left from the purchase 2 and the 5 units from the last purchase. So I have 28 units. I sold 28 units. Is that true? Yes, that's 28 units you sold. So what's the cost of my ending inventory? It's going to be 1 unit sitting at $180, and you have another 5 units sitting at $200. So the total cost of your ending inventory is going to be equal to, ending inventory at this point will be this one plus that one, or 1,180. Where is our cost of goods sold? Well, the difference, 5,800 available minus 180 minus 1,000. Our cost of goods sold is $4,720. And that's where we are. Our ending balance is $1,180. Now, let's move to the weighted average. Weighted average should be a little bit way easier in this case. Why? Because the only thing that left is to get the ending balance here. And we already know what's the cost of our unit of the ending balance. And the ending balance, we have 6 units left. We already know the cost of those 6 units per unit is $173.53. So the total cost for those 6 units using the average price is Sorry, not this one, not this one. It's give me trouble. It's gonna be this one time that one. $1,041.80. So in that case, my cost of goods sold is gonna be equal to, for example, I have 28 units left, and the cost of that 20 units, so it's 20 units sold, and the cost of that sold units is $4,858.82. And that's how you should solve these problems. Gonna stop sharing and gonna go back to the questions. That was question 5, and this is the rationale for the question 5. Please remember those and have in mind those general rules, how to calculate the cost of goods sold and how to calculate the ending inventory. Please. Next question is the question number 4, which happened on your test 4. This question is gonna come on the final exam. I can promise you for that. So in order to solve the question, we're gonna flip again to the Excel spreadsheet. So I have copied the picture from the question, and now we're gonna move to the Excel spreadsheet, which is right here. Now in this case, I need a fresh Excel spreadsheet. And let's pose the question right here. This is the information about the inventory and what's happened with the inventory in this case. The other thing but that's obviously that's not enough information. We need to get a little bit more information about the question. So let's go and check the question again. So as you can see, this company, shoe company, has a periodic inventory system and use a gross margin method of estimating inventory for interim financial statements. Company had the following account balances for the fiscal year. The requirement is use the gross margin method to estimate the cost of the business ending inventory, assuming that the business has an average cost of 60%. So let's go back to the Excel spreadsheet. And I'm going to paste this one right here. That's not what I wanted, but I guess that's the best I can get in terms of the question. The company, let's see if that's going to solve my problem, partially solving my problem. So now I have the question and I have everything on the same spot. Okay. So at this point we got. So what we have to do, we have to calculate the ending inventory using the gross margin method, knowing that the cost of goods sold is 60%, average of the 60%. That is what we need to use. Using the gross margin, assuming that the business average cost is 60%. For the purpose of this question, we can use the following general rule, which is right here. How are we going to get cost of goods sold? First, we're going to start with the beginning inventory. Then we're going to get the purchases. Then we're going to deduct the purchase discount and purchase return allowances. Then we're going to get the net purchases. Then we're going to get the freight in. And then we're going to get available cost of goods for sale. Either we're going to get the ending balance to get the cost of goods sold, either we have to get the cost of goods sold to get the ending balance. In this case, we're chasing the ending balance, so we have to play with the cost of goods sold. What do we know about the cost of goods sold? Well, cost of goods sold coming from the inventory account. On which side of the inventory account? That will be on the credit side of the inventory account. So what we have to do? Follow the same logic. First, how much is our beginning inventory? Our beginning inventory in this case is 195,000. I'm trying to get some formatting here in order for me to be easy and not to go crazy with the formatting, but once I have here formatting, I can easily flip it everywhere. So my beginning balance of the inventory is 195,000. Then what do we have to add? I have to get the purchases. And then following the chart below. My purchases at this point are 1,157,123. Then I have purchase return in this and allowances less purchase return and allowances which is my purchase return and allowances at this point are 23,000. So my net purchases, only my net purchases on this point, trying to make it more nicer so you can see, my net purchases are equal to my purchases less my purchase return and allowances. I have my net purchases. What else I have to add? I have to add the freight in. And the freight in this case is $11,000. At this point, I can say I have cost of goods available for sale. And that cost of goods available for sale, so all those three together. And I have my first calculation. Now I have my total that I have available. In order to get my ending balance, I have to deduct cost of goods sold. Once I deduct the cost of goods sold, I'm going to get the ending balance. Now the question is, how can I get cost of goods sold? Well, from the income statement, I already know that sales less cost of goods sold, that's going to give me gross margin. And since we're using the gross margin method, that's exactly what I need. I need the gross margin method. So they're using the gross margin method and they're estimating that the cost of the business ending inventory, assuming that assuming here, assuming the business has averaged 60%. So which one will be 60%? That will be my 60% here. Cost of goods sold will be equal to 60%. How much are my sales? 100%. I already know that. I already know that my sales are 100%. Cost of goods, gross margin obviously will be equal to 100 minus 60. But that's irrelevant in this case because we don't have to go all the way to the gross margin in this case. So how can I get my cost of goods sold? First, I have to get sales, but I have problem because I have sales and the sales return. So only the sales is not going to solve my problem. I need to deduct from my sales return. So I need to work here with the net sales. And the net sales, I'm going to get it as a sales less sales returns. And allowances. Well, I already know my sales. My sales are 1,922,000. What I need to get? I need to deduct my sales returns, which is 22,000. And that's going to give me the net sales. My net sales are equal to 1,922,000 minus 22,000, and that's going to be $1,900,000. That will be my net sales here, right here. What else I know? That I know that my cost of goods sold is 60% of the sales. So that will be equal to sales times 60%. Then obviously my gross margin will be sales minus the cost of goods sold. If you want to check yourself, just get 760 divided by 1,900,000 and see if you are actually on the 40%. Yes, we are. So that means my cost of goods sold is equal to this number here, right there. Should be negative, but that should be equal to that. So ending balance in this case will be equal to my cost of goods available for sale minus the ending inventory. My ending balance will be $200,000. And that's how you solve this type of questions. Again, that chart is given to you on the set of the questions. Please use it. Let's go back to the set of the questions and let's continue with the next one. This question is from chapter 6. So from chapter 6, you're going to have two questions. One's that calculating the first in, first out weighted average, and one to calculate me the ending balance using the gross margin method. There'll be one more question from this chapter, which is related to preparation of the income statement. From this question, I'm chasing you to prepare the income statement. How can you do that? Well, this information here is not given to you. The only thing that's going to be given to you is the net sales, beginning inventory, that will be the net purchases, ending inventory, cost of goods sold. So what do you have to do is, once you get the net sales, which are 76,300, that with comma 76,300, I should be hitting this enter. Then we have to get the cost of goods sold. I don't have the beginning inventory, but I have the net purchases. So then my net purchases is 46,500. And I have ending inventory, which is ending inventory is 10,200. So my cost of goods sold are $50,000. I don't know how much my gross margin is, but I know how much my operating expenses. My operating expenses are $9,700. So what do I have to find out? I have to find out how much of my cost of goods available for sale, How much my gross margin? I already can say my gross margin is 26. 376 minus 300 minus 50,000, 26. 300 minus 9,000 and 1,700. That's going to give you a round number of very nice number of 26. 300 minus 9,700. That will be 16,600 here. 16,600 is right here. Now you have to work backwards to get the beginning inventory. What do we know? We know that the cost of goods sold are equal to the cost available for sale minus the ending balance, ending inventory. If something minus this one gonna give you 50, what's the number here? Obviously, the number here will be 60,200. And if this is the total between net purchase beginning inventory out of 60,000, 46,500 is out of 60,000. What's the beginning inventory? Well, obviously the beginning inventory will be 60,200 minus 46,500, and that's going to be 13,700, 13,700, and that should be your answer for this question. So what you have to do is get the numbers here using this logic and fill the income statement. That's what you have to do. This question shouldn't take you more than 5-10 minutes maximum. The solution is given to you on the end. After that, 76,300 minus 50,26 minus 97, 16,600. Then once you have the cost of goods sold, work backwards to get the cost of goods available for sale, since you know the ending inventory. Once you get cost of goods available for sale, work backwards to get the beginning inventory, and you're there. Nothing scary with this question. I don't see any challenges with this question. It's mostly math. Here, there's another question for you. With the company fiscal year for the quarter, operating expenses using the periodic inventory system, and these guys, they have determined what's the cost of department ending inventory at March 31st under the weighted average and first in first out, and round and prepare department multi-step income statement for the quarter ended March 31st under each method described and requirement. First, that means you have to do weighted average and first in first out. So the question here is, do we have the beginning inventory? Yes, we do have the beginning inventory. Do we have all the purchases? Yes, we do have all the purchases. Do we have the ending balance? Obviously, we have the ending balance. How are we going to get the ending balance? Total units that we purchase minus the total plus the beginning balance. Don't forget the beginning balance minus the units that we sold. We're going to give us the ending balance. Okay, let's get busy. I'm going to flip again to the Excel spreadsheet because the Excel spreadsheet is going to help me a lot with this question. What I have to do is get one of those. I can get one of those and then modify it, or I can start fresh and using whatever I need from these questions. So what do I need first? I'm going to flip this, which is my purchases. Those are my purchases. Then I'm going to get my sales. Those are my sales. What else I need to get? I need to get information about my beginning balance. And once I have all those that information, I can easily start working. And the beginning balance in this case is the company fiscal year end is March 31st. On January 1st, inventory consisted 20. I have here. And that's the information about my beginning balance. Once I have all this information, I can start working. At this point, I'm going to use one of these templates. Since I have it available, I'm going to use it. Flip it here. Just to modify it a little bit to fit the format that I need. And I'm going to work beginning balance. My beginning balance, I have 20 office dividers, which cost me $1,800 each. Then I have January, then I have February, and obviously I'm going to have March after. In January, I purchased 60, on February I purchased 40, and in March I purchased 30. In total, I have 150. Ending balance, I don't know how much is it. My first purchase is $1,850. My second purchase $1,900. My third purchase $1,950. So at this point, I have my available, my total cost. If I need weighted average per one divider, I can easily get it. I have the total cost divided by the available. I'm going to get the average cost. Now, what we have to find out, how many units we sold. This is the second calculation for the units sold. In order to get our cost of the number of the units that we sold. That's going to give us, in this case, since we're chasing the ending balance, first we're going to see how much is our ending balance, how many units we have in our ending balance. Once we find out how many units we have in the ending balance, then we can easily get the cost of goods sold. So first I need how many I sold, cost of goods sold on the unit side only. I'm working on the unit side only on unit in unit. If you want, I can flip this one here, and at this point I care only about the units, nothing more, nothing less. On the sales price, then obviously there will be no beginning balance on the sales price. I can easily get rid of this row, and what I'm gonna have, the units that will be my sales price. I set this again and total sales. That's gonna give me total sales. So first I'm selling January, I sell 50 at 3,600. Then I sold in February 20 at 3,700, and in March I sold 34 at 3,800. In total, I sold 104 dividers, office dividers. So I had 150, I sold 104, 104 here, sold. I don't need this columns here. I can easily erase them. 104 I sold. My ending balance as a number of dividers is equal to 150 minus 104. I have 46 available. So my ending balance here is 46 units. And now I can start working out what's the cost of those units. Once you find the cost of those units, you can find the cost of goods sold as a cost. No, so number of how many units you sold, the total cost. So let's get it the way we did it before. I'm gonna copy this, I'm gonna paste it here, and I'm gonna start working only and only with this calculation here, because now I know my cells. My cells, I can use it for preparation of the income statement, but at this point I need to know how many units I sold, which is exactly 104 units. We already established that. Now the question is, if I'm using first in, first out, what will be the cost of my ending balance? Ending inventory of 46 units. Well, I don't have to do, in this case, I have to do some calculation, right? So first thing first. 46 units, obviously, they coming from my last purchases. My very last purchase is 30 units at $1,950 per 1 unit. I definitely have those 30 units. What else I have? That's going to give me total cost of 58,500. Then I need another 16 to make it 46. 16, those 16, they're going to come from the second last purchase, which cost per unit was $1,900. And that cost is 16, cost me 30,400. So my ending inventory, the total cost of my ending inventory is for $88,900. That means I sold, that's how much I have available, minus 16 and minus 30, which is 46, I have 104. My cost of the goods, of those goods, 104 units that I sold, their cost is 281,500 minus 30,400 and the first 16 from the second last purchase, minus 58,500 from the last purchase. So my cost of goods sold is $192,600. And that's how you're calculating the cost ending balance and cost of goods sold under periodic system when you're using first in and first out. Now the second scenario is if we're using the weighted average. As we already figured out, the weighted average should be a way easier than this. I'm spending too much time on those questions. I shouldn't be spending, but I want you to understand it. So in this case, I don't need this column here. I can easily get rid of it because I know that I sold 30 units and those 30 units, my ending balance, is 46 units here. I already know it from this calculation, and I know that my ending balance as a number of units is 100, and as cost of goods sold is 100. If I sold 104 units, my ending balance 46 units only. Now at this point, I'm asking myself, how much is my average cost of the available units that I have? I have 150 units, a total cost 281,500. So the average cost of every single of those units is the total cost divided by the total number of units. And this is the number that I'm getting. And that automatically will become the cost of my ending inventory per unit. In the total, 46 times this number is going to give me the ending inventory in total. That means cost of goods sold are total available minus the cost of the ending inventory is going to give me 195,173.33. And after that, I have to do the income statement, which should be very straightforward, which is going to consist something like a revenue, cost of goods sold. I'm going to copy this because this video getting too long, and I'm going to flip it to the Excel spreadsheet and I'm going to show it to you right here so you can see it. So my revenue here is the same that I calculated for my sales. Those are my sales, my cost of goods sold under the weighted average. I already have it. When you round the numbers, if we're rounding the numbers, that's the numbers that you should getting. Gross margin, operating expenses, which were given to us in the beginning of part of the requirements, we're getting the operating income. Same thing you have to do here. And that's your next question. That was question number 8. And at this point, we can move to the next questions, which now we're moving away from chapter 6 and we're going down to chapter 5 question, which is question number 9. On the chapter 5 question, what you have to do is you have to show me that you know how to do a journal entry for the periodic inventory system. We're going to have all those events. So what you have to do is show me the debit and credit. On to June 1st, what's happened? We purchased 16,800 inventory under the term 210 and 30 and freight on board shipping point. So what will be our journal entry? Debit inventory. Sorry, it's not inventory actually, but since we're doing the periodic system, that will be debit purchases. And the credit's gonna go to accounts payable, since we're not paying. And the amount will be exactly the same, 16,800 here and 16,800 right here. And that's our journal entry for the date of June 3rd. Then on June 7th, what we did is we decided to return those defective materials, merchandising that we purchased on June 3. What will be that? Now we have to debit. We're not going to debit the purchases now. We're going to debit, since we're returning them, we're going to reduce our accounts payable. Accounts payable is going to go down with the amount that we're returning, because we're not going to pay that $1,600. And since debit has to be equal to the credit, we can easily plug the credit here. So which account we're going to create in this case? In this case, we're going to create the purchase, return, and allowances account. Then we're going to pay the freight, which pay the freight we're going to be on June. That will be June 9. We're going to pay the freight, and that will be debit freight in. And we're going to pay the freight in cash with cash. And that freight is $350. Next journal entry will be, now we're selling the inventory and collecting cash. And all for the remaining, we accept, we actually provide the terms of 2% within the 15 days and no discount within 13 days. And that's happened on June 10. And that will be debit for us will be, first we're going to get the cash of 3,600. Then the rest is going to go to accounts receivables, and the credit is going to go to sales. Sales revenue. Total revenue here is 22,400, and you work out to get the amount of the accounts receivable, which in this case is 18,800. Then we're going to pay the amount that we own the credit purchase on June 3rd. So how are we going to pay this amount? Obviously, we're going to pay it cash. On the June 12th. It's obvious we're going to pay cash. That's credit will be cash. The question is how much cash we have to pay. First, let's do. We have to close our accounts payable. Debit accounts payable. How much is the accounts payable at this point? Well, first we own 16,800 for the initial purchase. Then we reduce the accounts payable with 1,600. So technically, outstanding accounts payable at this point is only 15,600. We're closing it. Since we're closing it within 10 days, on the 3rd and 12th, on the 99 day of the purchase, so we can take the 2% discount. 2% discount on the 15,600 will be $312. So we don't have to pay $312. We don't have to pay it. So how much are we going to pay? We're going to pay 15,600, only 98% of the 15,600, which in this case is 15,288. That's how much we're going to pay. The rest is going to go to the new account, which is credit that will be purchase discounts. $312. Next, the next thing that we have to do, we're gonna provide a tax allowance for the 1,200, which is gonna reduce the amount of the accounts receivables to $17,600. And once we receive the cash, we're gonna do exactly the same that we did with accounts payable. So 15,200. Yes, I'm wrong here. That's 15,200. If we're using that number, 15,200 times 0.98%, that seems. Here we're gonna pay only 14,896, which is gonna give us a discount of 2%. I wasn't incorrect with the 15,200 times 0.02. That's $304. $4 purchase discount here. Again, 16,800 minus 1,600, that's clearly 15,200. You have to do the same thing here. 18,800 minus 1,600. Those make the same mistake that they made. That's 17,600 here. Find out how much cash you're going to get. In this case, you're going to get 17,348, and 352 will be the sales discount. As you can see, with the discount on the purchases plus the sales discounts, we are short only $48 in this case. That's how you have to do those journal entries. This is from chapter 5. This is the question that's going to come from chapter 5. Now from chapter 5, there will be another question that's coming. But before we go to that question, I want to show you the question 10, which question 10 is from chapter 2, which is the simple journal entries. I'm giving you this question just to make sure that you know how to do a simple journal entries. And this question just have to show debit and credit, and if there's explanation, provide explanation. In the first transaction, the owner invested 20,000 cash, invested land, and building. And that was credited to his account. So debit will be debit, cash 20,000, land 60,000, building 120,000. And everything's going to go to his capital account. That's how you have to do this. Next journal entry. Purchase office supply on account. Debit office supplies, credit accounts payable. Paid 15,000 cash for the office furniture. Debit office furniture, credit cash for the office furniture purchase. Paid employee salary. Debit salary expenses, credit cash. Perform consulting services on account for client. Now we providing the services to our client. Well, every time when you see client, that means you're the seller, the client owes you. Either he's going to give you cash, either he's not going to pay you cash. He's going to get it on the account. In this case, you didn't get anything, but that's to create accounts receivable for you and service revenue. Debit accounts receivables, create service revenue for $20,100. Then you have to pay cash for the accounts payable, which you have on the June 3rd. So you're going to pay debit will be accounts payable, going to go down with $800, create cash with $800. Then we're going to receive 2,000, and then we receive a bill for the advertising expenses that will be paid in the near future. So that will be advertising expenses, debit accounts payable. Perform consulting service to client, to customer, and receive cash $5,600. Now we're getting cash and providing service revenue. Next thing is we receive cash on account. Cash on account comes from the June 15 when we perform the customer services. So that will be debit cash, credit accounts receivables. Next thing that we pay the following expenses with two separate checks. So that's cash going out. Rent expense 1,700, credit cash. Utility expenses 400, credit cash. And the last thing, the owner withdraw 6,500 cash for personal use. Debit capital account for this person, credit cash. That's all you have to do. Journal entry and simple explanation. At this point, at this level, I don't think you should have any problems with those journal entry, but just to make sure that you don't have problem, I'm giving you this question so you can fly on this question, get the confidence, and get ready for the next question. Next question here, that will be from chapter 3, which is adjusting entries. Luckily for you, I'm not going to test you for this type of question from chapter 3. I found a way more interesting question. Again, here what you have to do, you have to do the adjusting entries. Adjusting entries, don't forget on chapter 3 we talk about those adjusting entries. One of the adjusting entries is related to the cash that you pay or received, but you defer the event. If you pay the cash, that will be prepaid expenses. If you receive the cash, that will be unearned revenue. And the other event is when you haven't paid the cash, but you provide the services or you use somebody else's services. So that will be accounts payable and accounts receivables when you provide service. The last thing is the amortization. Here, we collected rent in advance, and then the tenant was paying for 1 year rent in advance. On this December 31st, obviously, we have to adjust for the rent that we earn. If $48,000 is for 12 months, get it per month, then calculate from June 1st to December 31st how many months you have, That's most likely will be 7 months, not 6. Time the amount that you're getting from the calculation, you're going to get the total. Interest revenue has been earned but not yet received on the 60,000 not receivable held by the business. So we earn it, we haven't received it. So that will be receivable for us. Interest receivable, create interest revenue. Salary expenses, if that's how much you pay per day, Monday to Friday, and if the year end falls on Wednesday, how many days you have? That would be Monday, Tuesday, Wednesday, times 7,500, that will be 22,500. What you have to do, debit salary expenses, credit salaries payable. Now for the equipment which purchased at cost of $200,000 with useful life 5 years, which you're not going to have value after 5 years, you have to record the year amortization. Since you're not having the purchase date on the equipment, you're assuming that this equipment was used for the entire year. So 200,000 divided by 5, and you're getting per year annual amortization, and problem is solved. On September 1st, when we paid $6,000, when we paid, now we're paying 1 year insurance policy, we debited prepaid insurance and credited cash. What do we have to do on December 31st? Obviously, we have to recognize that expense. That will be insurance expense. Create prepaid insurance for the portion between September and December 31st. That will be September, October, November, December. That's 4 months. And you get it done. That should be 500 per month. Business owner interest expense of 7,000 that it will pay early in the next period. So business owes interest expense. So that will be debit interest expense, credit interest payable. And unadjusted balance of supply account was 13,500. The total cost of supply remaining on hand is only 4,500. So that means from 13 to 4, we have to bring it down from 13 to 4. That will be 9,000 of the office supplies we used in the operation. So that will be debit office supply expense, credit office supplies. And that's how you're doing those journal entries one after another. Now, the question that you're going to see, again, is not going to be this question, it's going to be this question. What's the difference? The difference is you still have to do the adjusting entries, don't get me wrong. But you also have to do closing entries. The good thing is those closing entries are the perpetual system. So let's see the question first. This unadjusted trial balance below pertain to December 31st, 2023. So I can copy this and move it to the Excel spreadsheet. And then I'm going to move to the Excel spreadsheet completely so you can see the questions there. Just give me a second. And those are the additional data that we have. I'm going to flip that additional data also in the Excel spreadsheet. And we're going to go back to this Excel. First, we have to journalize the adjusting and closing entries to this company. And then we have to determine balance of the capital account. In order to determine that balance, we have to do the closing entries. And once we do the closing entries, we have to do this. So let's go, let's get busy. Seems like a difficult question. At the end of the day, it's just a very, very, very simple question, which I don't think is going to give you a challenge, but you can always surprise me. So let's start first with this information that we have available. This is the additional information that we have. As you can see, we have cash, accounts receivable, all those accounts. The question is, those events, A, B, C, D, E, F, how they're gonna affect those balances here? First thing you should know, cash is never gonna be affected. Why? Because cash is not involved in adjusting entries. For everything else, we have to figure out. What I can do is I can put myself here debit and I can put here credit. I can start working with those balances. Actually, to be in the line of the question, I can flip it on this row. Try to put it exactly to match the rows so we can easily transpond those numbers like this and get the final balances here. Those will be my adjustments. Yeah, and this will be the balances at the end. Again, that will be my debit, and this will be the credit. So let's start with the journal entries first. I can use one here to insert, so to put the letters on the journal entry. Insurance expenses for the year should total 21,600. So the insurance expenses for the end of the year should be 21,600. Where is my insurance expenses right now? My insurance expenses is only 6,000. Can you see it? But this question says that my insurance expenses at the end of the year, I'm trying to adjust it just a little bit to match exactly the rows. That should be like this. So my insurance expenses at the end of the year should be 21,600. That's where I should be. Right now I'm not there. Right now I'm only put the time separation, put OK, and there we go. Right now I'm only 6,000. So how can I break 6,000 to 21,600? Well, obviously that will be equal to this one minus 6,000, and I need expense of 15,600 in order to bring it down. So I need debit on the insurance expense for 15,600. If I debit insurance expense, since I'm at the end of the year, I'm doing adjusting entry and I'm not touching cash, from where I'm going to get it? Obviously from the prepaid expenses. What's going to happen with the prepaid expenses in this case? They're going to go down. Now we have to figure out how much down the insurance expense is going to go. I think I'm not in the line right now. I fix the lines. Let me try this way. Right now. Here we go. So if my prepaid expense going debit here, I have to plug credit here. That will be 50,600 here. And that will be my letter A. And letter A here. And the first one is done. Next one. Insert here, push it down, and get this one. Store fixtures have an estimated life of 10 years and are expected to have no value when they are retired from the service. Do I have store fixtures? I have. I'm not purchasing them now. They've been purchased, so I don't have to worry about them. I'm still not in the good lining on my cells. So just give me a second somehow to get it online because I'm flipping between the lines here. I just want to make it sure that one line is exactly the equal to the other lines. Still flipping. Still having some problem with this aligning. I'm so sorry about this. Just improvisation right now. Here you go. I think that's perfect. I just want you to. I want to make sure that you're getting the right thing. So that should go right here, and this one should go right here with the insurance expense. So there will be no confusions later. Which line going where? I think that's perfect. So we're getting those 270,000, which is for 10 years. So what we have to do, we have to show the amortization, annual amortization. Since we don't have the date of the purchase, we're assuming that we're using that for entire year. And since we're using it for 10 years, 270 divided by 10, that will be $27,000 amortization expense for the year, which is going to give us the accumulated amortization increase with 27,000 on the credit side. And we're done with this. Next thing that we have to do is the accrue salaries on December 31st for $5,500. So what we're going to do, we're going to go to those salary expenses and we're going to put 5,500, adding that letter C, and we're going to increase our salaries payable with 5,500, that's letter C. Then we have to accrue interest expense, $1,600. That will be here. We're going to add $1,600 interest expense. That's in letter D. And that's going to increase our interest payable to $1,600. That's letter D. Then we're going to have store supplies on hand at $23,800. Where are our store supplies right now? They're $28,800. So we're saying at the end of the period should be $23,800. That's how much should be. So how can we bring 28,800 down to 23,800? By crediting with 5,000. And that will be letter E. Once we credit office supplies, we have to increase office supply expense, store supply expenses with $5,000 right here. That's letter E. And the last thing that left is the inventory based on the inventory count. On December, 160,500. So in this case, that information, we're going to use it only and only for the closing entry. At this point, what we can do our check. What will be our check? Our check to see is the debit equal to credit, which should be. So since those are equal, then we can move to the next point to flip those balances here, 2,250. That will be 109,600. This inventory is 108,300. We stay with that inventory. We already come up with the balance for the that will be the balance for the store supplies. Prepaid expenses, we have to reduce that balance. That will be 18,000 minus 15,600. That will be 2,400 only. Store fixture is going to stay the same balance, but our amortization expense, the accumulated amortization, is going to increase to 162,123 plus 27,123. That's 289. Accounts payable, there will be no change in accounts payable, 69,900. Salaries payable is going to increase to 5,500. Interest payable is going to go to 1,600. Notes payable long term, no changes there, 47,133. Capital, no changes at this point of the capital. Withdrawals going to stay the same, 52,123. Sales, no changes in the sales, 29,500. And then we go to the expenses. First is the purchase, 737,900. Then we're going to have salary expenses. We have to increase it with 5,500 to 38,600 plus 5,500. 52,000 is the rent expense. No changes there. Utility expenses, no changes. 36,200, no changes. Amortization expense, now we have 27,000 amortization expense. We already come up with the insurance expense. Store supply expense of 5,000. Interest expense, we have to add 1,600, 2,350 plus 1,600. And the last thing that left is 6,500 miscellaneous expense. So if we are correct with our totals, since the beginning balances are non-adjusted is in balance, our adjustments are in balance, the new adjusted balance should be exactly the same. Let's see if that's the case. Yes, we are in balance. At this point, what we have to do, once you have this, you have the journal entries available for you directly. What you have to do, you have to do it. This is the journal entry 1. You can highlight it in different colors and start doing it. That will be debit insurance expense, credit prepaid insurance. Letter B, that's letter A. Letter B, debit amortization expense, credit accumulated amortization. Next journal entry, letter C. Debit salary expenses, credit salary payables. Next ABCD. D is debit interest expense, credit interest payable. That's your D. And the last letter left is E, store supplies. Have to find out another color, which will be, let's find another color. This crazy color here. No, that's not appropriate color. Let's go with something else. It's this. 5,000 here, and letter E, 5,000 here, and we're done. You have 1, 2, 3, 4, 5 entries. Debit, credit, debit, credit. Once you do those entries, what you have to do, now you have to start closing the closing entries. What do you have to remember? Remember this. Once you see capital account and purchases are clearly below that line as part of the expenses, everything above, you're not touching it. You're not touching any of those accounts. Those are forbidden for you. But all these accounts, you have to bring them to balance 0. All those remaining, you have to bring them to balance 0. Let me find some color which is not that. that will be 0. Now, how can you bring it to 0? Well, we already figured out that beginning balance, since this is the withdrawal, beginning balance plus the credit, it's going to give you the, minus the debit is going to give you the, sorry, plus the debit minus the credit is going to give you the ending balance. So in order to bring that balance to 0, you have to credit it. Let me copy this one right here. So if you want to bring this balance down to 0, since it's debit, you have to credit it with the same amount. This amount, to bring it to 0, you have to debit it. 1,290,500. Now I'm a little bit off, but because the formatting doesn't work for me here. So those will be no covered for anything. But only this part you're doing the adjusting entry. So this, how can I bring it to 0? By crediting 737,900. This one 24,100. This one 52,123. 36,200 here. 27,123. 21,600 here. 5,000 here. 3,950 here and 6,500. That's what they have to do. And you have to do it with the closing entries. So first entry, with the first entry, you're gonna close the revenue. Debit. Sales revenue. With this amount, and credit income summary. With exactly the same amount. And we're done with the first. Second, you start closing all the expenses, all those expenses, one after another, starting with the purchases, sales expenses, rent expense, utility expense, amortization expense, everything all the way to the end by debiting income summary. And then credit expense. First is purchase, and then credit expenses. I'm not going to go and write all the expenses because that will be crazy exercise one after another. But what I can do is get those amounts and just transpose them here as expenses all the way to the end. All those credit expenses, different expenses. Once I get those one, I can tell you how much I'm gonna add to my income summary on the debit side. If you want at this point, you can open the income summary account. And that income summary account, obviously, is going to be T account. It's going to look something like this. So what you have to do is plug here. That will be your expenses. That will be your debit here on the debit side. This will be your credit side here. Everything that's come on the debit, that's going to come here. That will be debit. This is your debit. Credit side, you're going to have this amount on the income summary, that will be your sales. And at this point, you can easily see where you are as a balance, but we're not done yet. Why? Because number 4, as a story, is still part of the, yes, that can be number 3. Let's go with number 3 first, before we jump to the number 4. Number 3, since we're doing periodic, we have to close the beginning balance and we have to open the ending balance. How can I close the beginning balance? By creating the beginning balance. How much I have to create? 108, 300. If I credit this inventory account, I have to debit some account. Which account I'm going to debit? Income summary. So I'm going to do here debit income summary account, credit inventory, for the beginning balance with the amount of 1,800, $108,300. And after that, what I have to do, I have to open the the ending balance. How are we going to do that? Debit inventory for the beginning balance, for the ending balance here. And I already know my ending balance is 111, 116, and $500. Which account I'm going to create? I'm going to create income summary account for the same amount. So here what's going to happen? That will be inventory. Beginning balance going to come here. Here's going to come inventory. Ending balance. We have the beginning balance, which is 108, 300. And here we have the ending balance, which is 160, 500. So now I can get my totals. I don't need it that big. So my totals on the debit side will be 1,242,550. On the credit side will be 1,407 even. So where is my balance at this point? My balance is credit, luckily for the owner, 164,500. What do I have to do now? In number 4, I have to close this in the income summary account. How can I close credit balance? By debiting account. So that will be number 4. I'm going to debit income summary account, and I'm going to create capital, owner's capital, with the amount of 164,450. Once I do that, on this side I'm going to have exactly the same amount, and that's going to fix my problems. Now my balance here is 0. The last thing that left for you is to close the withdrawals. And that will be number 5. How can I close the withdrawals? By creating withdrawals. If I create withdrawals, I have to debit something. What I'm going to debit? I'm going to debit capital. Capital account for the amount of 52,000, and I'm going to create withdrawals account. With the same amount. And the question at this point asks, what's the balance of the capital account? Well, we can use this as a template for the time being. And what we can do is right here, I can paste it here. And that will not going to be income summary, that's going to be capital account. Balance is credit, obviously. gonna delete those one. Beginning balance is on the credit side. Always have beginning balance here. Beginning balance, and my beginning balance on the capital was 119. Then I have from the income summary, I have amount of 164. And then from the withdrawals, I have 52,000. So now the question is, where is my ending balance? My ending balance will be beginning balance plus the credit minus the debits. My ending balance is $231,450. And we're done with this question. I realizing that I'm not sure if I share my screen with this question. So I guess I have to do it again. Okay, let's do it again. So again, what we have to do is follow the requirements and additional data provided and go one after another. First, for the insurance expense, see what it says here. It says the insurance expense for the year should be total 21,600. So my insurance expense here at the end of the year should be 21,600. But right now, my insurance expense is only 6,000. So what do I have to do? I have to make it. I have to add 15,600. If I add 15,600, my ending balance will be 21,600. And that will be letter A. Now, once I do letter on the debit side, I have to create some account. Which account I'm going to create? I'm going to create prepaid expense. How much? Exactly the same amount. I have to be in balance. And that will be our letter A. Next thing that we have to do is letter B. Store fixtures have estimated useful life 10 years. We're checking the store fixtures and we're seeing that they're $270,000 over 10 years. That's $27,000 per year. And since the the purchase price is not given, we're assuming that those are available for the entire year. So we have to record the amortization for the entire year. So what we're doing is 27,000 amortization with letter B. And since we have a debit, now we have to plug the credit. Credit, we're gonna go to accumulated amortization for the store fixtures, which is $27,000. That's letter B. On letter C, we have to accrue salaries for $5,500. How can we do that? By debit salary expenses with $5,500. That letter C. If we debit salary expenses with 5,500, we have to create some account. That will be salaries payable, 5,500. Don't forget, on the adjusting entries, you're not touching cash. Cash is forbidden for you. no cash. Everything else except cash. Letter D, accrue interest expense. Now we're accruing the interest expense. Let's put that interest expense. We're going to add interest expense 1,600, and that will be letter D. And we're going to increase our interest payable to $1,600. That will be letter D. The last thing that left is the store supplies on hand on December 31st to 23,800. That's how much we have available. So what that means? That means that our balance on December 31st should be 23,800 only. Currently it's 28,800. So what we have to do? We have to reduce it on the credit side. 28,800 minus 23,800 with $5,000. But if we credit office supplies with 5,000, we have to debit some account. That's letter E. That will be debit is going to go to office supply expenses for the $5,000. That's letter E. At this point, what we have to do, checking that debit and credit are equal, so we're fine. What we have to do, we have to calculate the ending balance of all the accounts that we have. Cash, 22,150. Accounts receivable, same, 109,600. Inventory, same, 108,300. So office store supplies, we already calculated. Prepaid insurance is going to go down from 18,000 minus 15,600. It's going to go down to 2,400. Store fixtures, no changes there. But accumulated amortization is going to increase from 162 plus 27,000. Accounts payable, no changes there, 69,900. Salary expenses, those going to go to 5,500. Salary payables. Interest payable, also going to increase to 1,600. Note payable long term, no changes there, 47,123. Capital, no changes there. Withdrawals, no changes there. Sales revenue, no changes. Purchases, also no changes. The change is going to come to salary expenses. That will be equal to 238,600 plus 5,500. Rent revenue stay the same. Utility expenses stay the same. Amortization expenses increases to $27,000. We already have the insurance expense already be given to us. Store supplies increasing to $5,000. Interest expense, it's going to increase with 1,600, so 2,350 plus 1,600, 3,950. And the miscellaneous expense is going to stay the same, $6,500. And at this point, as you can see, we are in balance. Why? Because the starting point is in balance, adjusting entries are in balance, and our balances on the adjusted trial balance is the same. Once we're done with this, we have to close accounts. So the general rule again is everything, if the purchases are below, everything above the capital, don't touch it. Don't even think about touching it. So all those accounts, you're not closing them. Which account you're going to close? Anything below. How can you close it? Well, it depends on the account. If the account has debit balance, you have to plug credit, 52,000. If the account has a debit balance, you have to credit balance, you have to plug credit, 290,500. And then start closing everything. 737, that will be, you just getting those numbers and closing them. And once you do that, all those accounts, their balance will be 0. And that's your objective. This is your objective, to bring all those accounts to balance 0. How can you do that? Well, we start sales revenue. Debit with that amount, create income summary. Then start closing all the debit balances account, starting with purchases and then expenses. I'm not gonna go again with the expenses. I'm just gonna plug the amount and calculate how much is that. At this point, we can check what's happened in the income summary. Sales are more than the expenses, which is perfect. Next thing that we have to do is to figure out where is our inventory beginning balance. Since we're doing periodic system, we have to close the beginning balance first. So let's close it. Where I can close it? Obviously, I have to close it in the income summary account. So my balance here is 108,300. Once I close that one, my inventory is going to be 0 now. If I plug here, credit 108,300, my inventory balance will be 0. If I add 106,500, my balance is going to be that much. That's what I want, my ending inventory to be 116,500. Where those debit and credit going to go? To the income summary account. After that, we're going to check the income summary. As you can see, the income summary account has a credit balance, which is great for the owner. How are we going to close it? By debiting exactly the same amount. Debit income summary, credit capital. Capital of the owner increases. Close the withdrawals in the capital, and you're done with the closing entries. Now we have to check the capital account. Beginning balance is the beginning balance. Credit is what comes from the income summary. Here from this entry, capital. Debit is what we put from the withdrawals, and our balance, the owner's balance, is 231,450. Now you have it with the picture. Now I can stop sharing and go back to the questions. And see what else left with the questions. Again, this is I find this question more interesting than the adjusting entry. So there will be no questions from chapter 3. This will be the questions this type of question is going to come with adjusting entry and then doing the closing entries, because you have to pay attention on the adjusting entries and then we get the right balances to close the entries. Again, the test will be on the periodic system. Now, the next one, there are only two questions that left. From chapter 9, I told you I'm going to test you on accounts receivables and calculation of allowance of doubtful accounts, more likely calculation bad debt expense. And bad debt expense, you have 3 methods to do that. One method was percentage of sales, which I'm not going to test you. Second method is aging method, which I'm going to test you. And the third method is percentage of accounts receivables, which I'm also going to test you on. So how can you approach this question? Check the information first. First, you're going to have information about accounts receivables at the beginning and allowance for doubtful accounts at the beginning. Let's copy this information and start working on the Excel spreadsheet. I'm not gonna forget this time to share my Excel spreadsheet. I hope I'm not. That's the thing with the when we are not live, sometimes I'm forgetting, and by the time forgetting, the question is over, and I have to do it again, which I don't mind doing it, but the recording getting too bigger, but you can back and forth, back and forth, back and forth. That's the good thing for you. So this is part of the question. Let me get a little bit more from the question here, and I'm gonna stay only on the Excel spreadsheet. That's a little awkward here. Let's merge those one and make it like this. I hope you can see all the information here. Let's do some. I think that will help us. Now we have everything. The last thing that left is this chart, which looks like this. And now we have all the information. First, what we have to do, again, observe the question, see accounts receivables, and accounts receivables, you have accounts receivable. Let's pull the accounts as fast as I can, so we can see what's happening in those accounts. Those accounts are crucial sometimes, so please don't forget to use the T accounts either on the paper that you have available next to you, either on the Excel spreadsheet, whatever it's easy for you. Again, that will have the beginning balance, that's going to have ending balance. Now here the beginning balance is on the debit side, and that's 310,000. On the credit side, we're going to have any collection that we may have. So that's the accounts receivables. Let's get the same thing for the allowance for that for account. The tricky part here is that normal balance is on the credit side, not on the debit side. So that will be 10,000 here, right here. That's the only trick here. This is our debit, this is our credit, and same thing repeats on this side. So what we have to do? The requirement from this question is first to record the transaction for the journal entry, then opens allowance for that for accounts on 3 column, and then some other crazy stuff. Most of those requirements not going to appear for you. The only thing that I'm going to ask you is to journalize the journal entry and come up with the bad debt expense. So first, on December 31st, we wrote the following accounts. How we can do that? First, we have to do is debit. If we write them off, that means we write them off from accounts receivables. They no longer belong to accounts receivables. So credit definitely will be in accounts receivables. Where the debit's gonna go? Obviously, we cannot go with the bad debt expense because they already been recorded there. So which account we're gonna use? Allowance for doubtful account. First one we're gonna use that. That will be for the client 1, client 2, client 3. Client 1, client 2, client 3. I'm going to label it like that. And the first client 2,500, second client 2,200, third client is 1,100. And those are done. Now we have to do is the credit side. Credit side will be on accounts receivables. We have to credit accounts receivables. Once we credit accounts receivables, those accounts are clear. They're no longer on our books. This plus this plus this. 6,100. That's the first entry that you have to do. Second entry is to calculate the bad debt expense by using this H method. What can we get from the H method? First we can get is the numbers. We have first number is 179,000. Second number is 95,000. Then we have 37,500, and then we have 70,000. All together, that's equals to 328,500. Then we have the percentage, 0.1% is here. Now we can flip on the percentage here to see it, and that will be like that. On next one, we have 0.3%, then we have 5% here, and then we have 40% here. Next thing that we have to do is do the calculation. This number times the percentage gonna give us number of the allowance for doubtful account. Once we get all the totals, we're gonna get the final balance. This is the ending balance for allowance for doubtful accounts. Remember this. With this method, we're calculating the ending balance for the allowance for doubtful accounts. So, where is our allowance for doubtful accounts now? I'm gonna bring it down here so we can see it. So first, we're starting with $10,000. Then we plug in allowance for doubtful account all those three accounts. So 6,100, we plug it here. Our ending balance now, target ending balance, should be equal to 9,139. The question is, how can we bring this account? Well, how much we have to debit here? Sorry, credit here in this account in order to bring it. And that will be my second entry. Debit, obviously gonna debit bad debt expense. And then on the credit side, I'm gonna have allowance for doubtful accounts. How much will be that amount? That will be equal to this one plus this one minus that one. Let's think about it. 10,000 plus 5,239 minus 6,100. Is it going to give me 9,139? Looks like it. So that my debit will be equal here to that amount. And here I'm going to have to plug exactly the same amount. That was the first requirement. The second and third requirement, I'm not going to give you those one, but you can see what the solution is. The next thing that I'm going to ask you is you to calculate me the bad debt expense based on the accounts receivable method, which you're estimating that allowance for doubtful account will be 4%. Now will be only 4% from the ending balance on accounts receivables. So that will be 4% here. Right here, 4%. So how much will be allowance for doubtful account ending balance? that will be equal to the accounts receivables times 4%, and that's gonna be your, that seems like this one time that one. $13,140 will be my ending balance on the accounts receivables. Sorry, on the allowance for doubtful accounts. So this will be my ending balance on the allowance for doubtful accounts. So that's going to change my journal entry here, which means that on the second, if I'm using now the other method, my entry is going to change. Why? Because I'm still going to have 10,000 beginning balance. I'm still going to have 6,000 write-offs, but my ending balance is going to be 13,140. So the number that I have to plug here is $9,240. And that's your question for the calculation of accounts receivables and the bad debt expenses. So let's go back to the questions and to see the solutions. Solution 1 with the bad debt, and the last one is the calculation of the bad debt. I think I'm mistaken somewhere. Yes, I'm mistaken on the, let me stop sharing this. I'm seeing I'm deviating a little bit from the question, and my mistake is related to, I'm going to show you my mistake, is to this number, 2,200, not 2,500. And now we are the same as the answer. So this number here is going to be 5,800, not 6,100, 5,800. And once we change that number, now our numbers here is going to change. It's going to be, we're going to be exactly like the question. 4,939 under the aging method and 8,940 under the percentage of accounts receivables, which is exactly the solutions that you have available for you. 4,939 and $8,940. That's for that. The very last question that left is the PT cash. PT cash, how that work? First, you establish the PT cash fund. Then you're using the money from the PT cash fund. At the end of the period, checking how much you have left in the PT cash, how much receipts you have, or for what amount your receipts you have, and then you're putting back the cash to bring the balance of the PT cash for the original balance, which in first case is $250. In the second case, what you have to do is to establish the PT cash fund by debiting PT cash with 200, crediting the cash. Here we have this journal entry, which is the cash register, shows that the cash register tape that's coming from the cash register shows that you have $4,875 sales, but in fact you have cash 4,885, so you have $10 more cash. So when you have more cash, what you have to do, you have to use this account, which is called cash short and over. You're going to get the cash, the one that you have, you're going to record the sales that you have on the cash register tape, and the difference is going to go to the cash short and over. Now, if you have the PT, when you're working with the PT cash fund, which is already established to be $200 by debiting PT cash and crediting cash, in that case, you're going to see how much cash you spent. You spent 134 on the ticket, those coming from $21 supplies, $69.50 delivery expenses, entertainment $43.50, that's $143. But you found that you have only $56.50. So what that means? That means you're short of $9.50. So what you have to do, you have to bring it back. Let me show you this because now getting a little bit complicated. So let's go to the Excel spreadsheet and show you there how exactly this works. So this is the information that we have. Let me put it right here. This is the information that we have. So first we have PT cash. We established the PT cash account. Let me grab one account from the previous chart here. We have this PT cash, and the PT cash account beginning balance is on the debit side. Beginning balance was 0 before we open it. Then we debited PT cash credit cash for $200, right? Debit PT cash with $200 and credit cash. And now we're having in PT cash $200. That's how much we have. Now later on, and the ending balance obviously will be still be $200. Later on, we find out that in this account there are some activities. What's happened with those activities? The people start spending money. So we have beginning balance 200. Our objective is to bring the ending balance to 200 again. But the people spend money. And they spent, in fact, $134. So if we have beginning balance on the PT cash, $200, and if somebody spent on the office supplies, $21, on the delivery expenses, $69.50, and the entertainment expenses, $43.50, you expect that in this fund, ending balance should be this one minus this one minus this one minus this one. The ending balance should be $66. You're checking cash available, and you have only 56.50. Where am I? Obviously, I'm short. That will be cash short and over. In this case, we're short. How much we're short? We're short $9.50. So our actual spending is not $66, it's $66, 75 and 50. That's what we have to do. So we're gonna put those money back. So our spending is 134 plus $9.50, 143.50. 143.50 we have to add back to the cash in order for PT cash to have $200 again. And that's how this works. And that was your last question for today. And for this final exam review, I understand. I apologize for the question that I forgot to share my screen, but it's getting too late here. Anyway, thank you for watching this recording. Thank you for all the hard work and everything that you did or haven't done during the course. I hope you enjoy the course, and I hope you at least you found some benefits for you and some practical knowledge that you can use in your personal life from this basic accounting course. Again, thank you for your participation, and I wish you success on your final exam.